This will be the first part to our discussion on adjusting entries. What's the big deal? These adjusting entries, these are what the CPA makes. A lot of times it's just to record internal events of the business. That's not necessarily something that's proven by a source document. So let's take a look at some examples. Again, what we're looking at is between January 1st and December 31st, normal calendar year for a company. What happened during this period? We need to make sure we include everything that happened, even things that we don't write a check for or have an invoice for or have a memorandum for, because the life of the company is going to continue on, but we need to know during this period what happened. So there's a couple easy ones. We'll knock out the easy ones first. As you remember from Accounting 1, supplies are adjusted for the amount used. So I'll just say it nice and plain that time, as opposed to the nice, obnoxious way I usually put it. How do you do that? You debit your supplies expense, you credit your supplies for the amount used, and you've got the adjustment set. Prepaid assets are adjusted for the amount that they use up as well. Rent is one way you can prepay, so you pay for rent at the beginning of a month, you use it up during the month. Insurance, of course, is another. You would debit whatever the expense is, credit it, the asset, and you're set. Easy adjustment. Quick example, supplies per your trial balance of $4,000. You go ahead and at the end of the year you count, you only have $2,400. How much were the supplies that you used? $1,600. So then you would quickly do the adjustment, debit your supplies expense, credit your supplies. Again, you don't have a source document that proves this happened. You just kind of realize it happened. So you need to record it as an adjusting entry at the end of the period. Now we get into some more difficult ones. First one here is called unearned revenue. So you receive the cash now, but you don't earn the revenue till later. I think these are three good examples. Sports Illustrated. Think of magazine subscriptions. They get the money, and then they send out the magazine. Think of the Eagles. They sell season tickets, and then they have the games later on. And airplanes, the same way. You'll buy the ticket for the airplane, but have they really earned the revenue for that ticket? They really haven't earned that revenue until you get on that plane and fly that flight. So it's considered what's called a deferred revenue. That's the fancy term for it. And when you first make, well, not really your sale, but you first receive your cash, so you would debit your cash and you would credit an unearned revenue, which is actually a liability account. But it's more like a liability to perform. As long as you perform, you'll get your revenue. If you don't perform, chances are you need to issue a refund. Now, how do you adjust? At the end of a period, you would adjust for the amount that you actually earned during the period. And you would debit your unearned revenue, reduce the liability, and credit your revenue, increase the revenue. So just move it from one account to the other. How do you calculate it? Well, it's a little more drawn out. You take your unearned revenue, so the total unearned revenue, and you divide by the length of agreement, and then you multiply it by the length you actually earned. And I'll put an example to it here in a second. You could actually technically just take your unearned revenue, multiply by length earned, divided by length of agreement. I don't care how you do it, just make sure you're thinking through it. And sometimes it'll just be given. Make it a little easier that way. So here's a quick example. Eagles fans, they pay $20,000 for season tickets before the season begins. We all know that's like flushing money down a toilet, but whatever. Tickets are good for 8 games during the regular season and 2 preseason games, so a total of 10 games. So when they make their original sale, they get their cash, you debit the cash and you credit the unearned revenue, both for $20,000. As of December 31st in our example, we're going to say the Eagles have had 9 home games, so that includes 2 preseason games and then 7 regular season games. So how much have they earned? Well, you can do the calculation. 9 games have been completed, 10 total games, and you multiply it by the 20,000. So 9/10 of the 20,000 have been earned. 18,000. So how do you make the adjustment? Well, you debit your unearned revenue, reduce the liability, and credit your revenue. You'll earn the other $2,000 the next period, but you haven't earned it yet, so you can't record it as of December 31st. One more example here, or one more to walk through in this first set of discussion here. The accrued salaries. Accrued salaries are you incurred the wages now, but you'll pay the employee later. It's called an accrued expense. So you adjust for the amount that you incur during the current period. And again, I'll give you another example. and it would be debit your salaries expense, credit your salaries payable. The calculation that might be involved, you would figure out how much the employee had earned during the period you just hadn't paid yet. So hours worked times wage equals your accrued salaries. Following period, when you actually pay them, you'll debit salaries expense for the remaining wage, debit the salaries payable, which is from the adjustment, and credit cash and withholdings if you have some withholdings as well. But again, the main thing that we know is that adjustment up there towards the top. So here's a quick example. Let's say we have an employee who earns $10 an hour and works 8 hours a day, and they get paid every Friday. However, this year, Friday is January the 2nd. So the worker works December 29th, December 30th, December 31st. They get stuck going in on New Year's Day, and then they go in during the 2nd. So they work their normal 40-hour work week. On December 31st, though, how much of an expense have we incurred? So we have to figure out what amount has our employee earned. So December 29th, December 30th, December 31st, 3 days worth of work. You'll see he gets $10 an hour. He works 8 hours a day. The grand total that they have earned is $240. So the adjustment would be debit salaries expense and credit salaries payable. Just to complete the thought, when they actually get paid, or when we actually pay the employee on January 2nd, here's what it would look like. You would debit your salaries payable for the $240 because we owed them and now we're paying them, so we're getting rid of that liability. You would debit salaries expense for another $160. Why? Well, they worked 2 more 8-hour days, so they earned another $160 on January 1st and January 2nd. And you would credit cash and the various withholdings for a total of $400. So that's the first look. We'll look at a couple others in the next video.